I'm Maggie Williams, Special Projects Editor for Engaged Investor and Pensions Insight magazines. I'm here today with Paul Hatfield, Chief Investment Officer for Alcentra, and we're going to talk about secured bank loans. So Paul, could you tell me about some of the key characteristics of secured bank loans as an asset class?
Yes, secured bank loans are, as the name implies, we're at the very top of the capital structure. We're secured on the assets of the operating company, so where the cash flow is and where the real hard assets are, which is why the recovery rates have been so strong even through the whole global financial crisis. We saw loans coming through even in some investment grade with recovery rates in the high 70s, low 80s. So there withstood a very severe test just because you're right at where the value is. You're not removed like a high yield bond at the holding company level. They're floating rate, so they're attractive from the point of view of duration as an inflation hedge. We've seen inflows into the asset class when people get concerned about those factors. Obviously, at the moment, nobody's expecting interest rates to shoot up tomorrow, but at some point they have to go higher, and from that point of view, a floating rate asset is obviously attractive.
And from a pension fund point of view, how can these be used as part of a portfolio?
Yes, we're seeing a lot more interest from pension funds in the asset class than we've seen for a very long time, particularly out of the UK, down in Australasia. Historically, from our point of view, we've been a bit frustrated that pension funds have been very equity focused and not really devoted much attention to the loan asset class. I think as a result of so much volatility and a general downtrend in returns on equities over the past few years, people are seeing the attractions of loans. Where they would fit in, people either allocate them to their alternatives part of their portfolio, or the fixed income part, even though it's a floating rate asset, but it's part of the credit bucket, obviously. Because you're looking at low volatility, fairly steady returns on an unlevered loan portfolio at the moment in the sub-investment grade space of bank loans, you'd be looking at somewhere between 7 to 10% returns. So as a pension fund, that's quite attractive to devote some of your AUM to that area and just have an asset class that allows you to sleep at night. Is going to generate steady state returns. We're never going to knock the cover off the ball for you with loans, but you can just get a very steady state return, which will do what it says on the tin. We've got a very transparent asset class. We get very good information flows, so it's fairly predictable as to what those returns are going to be. So I think that would be where it would fit in.
Sure. And within the asset class, are there sort of geographical differences, say, between the US and Europe?
Very much so at the moment. We see far more value in Europe in loans at the moment than we do in the US. That's not to say that you're not badly paid in the US. What we've seen particularly this year and over the last 6 months, very large retail inflows, excuse me, I'll do that again. Very large inflows from retail investors into the loan asset class in the US. That leaves managers in the US with cash burning a hole in their pocket. They have to spend that, get it to work to avoid the cash drag. You therefore see, you can literally correlate the inflows into loan asset class with reduced margins and weaker terms. 25% of the US bank loan class now is covenant light. We haven't seen covenant light as a feature of Europe except at the very, very top of the bull market. And even then it was about 5 or 6 loans which were kind of multinational US, European businesses. So we've seen the discipline fade very quickly in the US. You're seeing smaller equity contributions from private equity sponsors to the capital structure. So whereas the average in Europe is about 40 to 50% of the capital structure being cash equity, in the US that's already falling down to the sort of 30s. And you've seen buyers willing to let sponsors dividend that money out fairly quickly after the deals have got going, and performance, to be fair, has been good. So you think you've got a nice equity cushion underneath you, but the sponsor's taken all the money out via a dividend. They then don't really have any skin in the game, and if the loan starts to become stressed, they're less motivated to look after it. Whereas in Europe, you've still got that hard cash underneath you. The two markets are very different in that sure, the US is more liquid, it's a larger market, it's longer established. Liquidity is perfectly fine in Europe, but it is a smaller market. The European market is a private market. It's about 95% private equity LBOs. In the US, the market is 50% private equity and 50% pure leverage of acquisition finance or corporates just levering up their balance sheets. So the US market, you're getting quarterly information flows. It's very ratings driven. You're making your investment decisions more in line with, what should this be priced at for a B2B credit versus a double B rated credit. In Europe, we get monthly information, so we get a lot more early warning in terms of any stress happening with the business, and we get much more detailed information because we're sharing the same information as the private equity sponsors have. So again, that gives you more transparency and better control over the outcome.
And are there any other key trends that you've seen in the European market in particular?
Yes, we've seen really the trend, if we'd been talking, say, in 2009 when there was a massive recovery in loan prices from the global financial crisis. You saw very strong pull to par, very big capital appreciation, and that was the bigger element of returns for loan managers at the time. What we're seeing now is European loans, because of the sovereign debt crisis in Europe, there was a bit of a sell-off. There's a lack of capital just because banks aren't lending so much anymore, so we're filling that gap. And that really gives us an opportunity to dictate very strong terms in how we want the capital structure to look, how tight we want the covenants, but also keeps pricing at very attractive levels. New issue is coming at sort of 97, so discount of 3 points. We're getting LIBOR plus 550, so the all-in yield on a sort of maturity of about 3 or 4 years is very attractive for the very top of the capital structure in a secured asset class. As I mentioned before, we're still seeing very strong equity injections. In the US, you've seen LIBOR floors still as part of the market because LIBOR's been so low. They've been arranging for a guaranteed minimum level of base rate for the loan. You've seen a lot more new issuance in the US than you have in Europe. So the technicals are very strong in Europe because there's a lack of supply of credit from the banking community. There's strong demand from loan managers like us with cash to spend. So that really sort of creates a firm base for continued attractive returns. I think this is going to be one of the most attractive vintages of loans to buy into just because you're getting so well paid for the risk that you're taking. Lower leverage in the structure, much less debt, bigger equity cushions underneath you, strong documentation in terms of the covenants and the headroom. But you're getting paid almost record amounts, LIBOR plus 550 and a discount. So it really is a very attractive time to be buying loans.
Sounds like good advice. Many thanks today, Paul, for your time.
Thank you.